Hata ni practice session. So when you start with
practice session.
So kuna kistima kina blink huko nyuma, mtu anakiona tu.
Nini?
Kile kistima kina blink huko nyuma. Kiona?
Nafaa kukiona. I get venye nimeenda. Haionekani sasa sasa. Tayari mbona nakaa iko nini? Is it central located? Hello. Oh. Hello.
Good morning, everyone. Thank you for joining us this morning. We'll start off the webinar at exactly 9:05. That is in 2 minutes. Good morning once again, everyone, and thank you so much for joining us this morning. I hope you've had an amazing week. As we anticipate the weekend, we have a few things to go through in terms of IFRS 9, and I won't keep you long since it's a lengthy but very productive and informative presentation. So I'll take you through a few things about BDO, just so you know who's talking to you, who's doing the training. If only my presentation worked. A few housekeeping rules. This webinar will be recorded just for your information. The presentation that my colleague Samson Okare will present will be shared with you, and you will also receive a certificate that you can present to your regulatory bodies for CPD points. We also request that you stay muted and turn off your video. Kindly share all your questions and comments on the chat section, and they'll be recorded and addressed. Most of them will be handled during this webinar. If not, you will be mailed to your email addresses. Also, ensure to share your correct names, because the names you've registered with are the names that will be shown on your certificate. So if you registered with the wrong names, kindly share the correct names that you want to appear on your certificate. Briefly about BDO, we are among the largest global networks when it comes to tax, audit, business service outsourcing, and tax advisory services. We have grown for the last 10 years. We have remained the fastest growing organization in our industry. And last year, we were the 5th largest audit firm globally. And as you see the statistics about us, we've done quite some good work since the inception in 1963, covered with the 10.3 billion revenue in 2020, 91,000 professionals across the globe, 1,658 offices. That means we have you covered in each area and region you are in globally. In East Africa, we have 5 offices in Kenya, Uganda, Tanzania, Rwanda, and we also do have more offices across the African region. The team in East Africa has more than 250 professionals, and this is basically our leadership team in Nairobi office. It's a much bigger team across East Africa and also the Nairobi office. Our services cut across audit, taxation, business service outsourcing, and advisory services, and services offered through cutting edge technology to our clients and our really experienced team. And we're also governed by the global teams. So the services you receive in East Africa cut across globally. So I will now hand over the presentation to Samson so that he can take you through the rest of the training. Thank you for joining us. Just a reminder, kindly put all your questions on the chat and question Q&A area, then we'll have all of them addressed by Samson. Just a minute as Samson sets up the account on his side. Thank you for your patience in the meantime.
Okay, good morning. Thank you for joining this webinar and sorry for the small hitch. Now, I'm Samson Okari, and I'll be taking us through IFRS 9 financial instruments. It's a short period to cover the whole of IFRS 9, but we'll try and see how we can cover the most important areas that we need to understand as far as IFRS 9 is concerned. So we are looking at key classification and measurement requirements in IFRS 9 and also key impairment requirements. Now, IFRS 9 was issued in November 2009, but a number of amendments have been done since its issuance. It was effective 1st January 2018 for financial periods starting on 1st of January 2018 or later. It replaces IAS 39, as you know, financial instruments dealing with measurement and recognition. And the objective of this standard is to establish principles for financial reporting on financial instruments to ensure that entities present relevant and useful financial information so that users of the financial statements can assess the amounts, the timing, and the uncertainty of the entity's cash flows. Now, why was IFRS 9 issued? So that we can now check if we have addressed the issues that it intended to address. The first one was to address cyclical concerns through consideration of changes in economic variables. How do we address the cyclical concerns through consideration of economic variable changes? For example, inflation, unemployment rates, the growth, the GDP of a country, and many other variables. How can we consider them and bring in them in determining the amounts that should be reported as far as financial instruments are concerned? Then there was the 2008 financial crisis, which it was established that we wait until a loss is incurred and record that loss in the financial statements, which they say that would have been too little, too late. So the other reason was to address that financial crisis of 2008. Then it was also to ensure transparency, that we are reporting all that is supposed to be reported or disclosed for users of financial statements to make an assessment of whether the amounts, the timing, and the cash flows have been disclosed as required. Then there was a requirement to change from rule-based to principles-based risk model. As you know, IAS 39 was a rule-based model, comply or comply. But IFRS 9 is a principles-based risk model, which requires you comply or explain why you've not complied with a particular requirement. In other words, it has that element of decision-making, whether whatever you're going to report is going to help the users of financial statements to make relevant decisions. Then there was a response to G20 and Financial Stability Board concerns, because they also were concerned about IFRS 9 and how, IAS 39 and how it used to help in determining the amounts, classification, and timing of cash flows. Now, before we embark on discussion on the IFRS 9 itself, we need to understand who does IFRS 9 affect and how does it affect them, because there is a misconception that IFRS 9 only affects banks and other financial institutions. So, of course, it affects banks, it affects insurance companies, it affects SACCOs. IFRS 9 affects microfinance institutions. It affects retail entities because they have receivables in their books. It affects manufacturing entities. IFRS 9 affects utility companies. So you can see the spectrum is that IFRS 9 affects all entities in one way or another, because all entities have financial instruments of some form. Now, since IFRS 9 was issued, what implementation effort has been made, and what can we discern from that? Now, for banking organizations, they have fully adopted IFRS 9 requirements using the general approach. You look at the general approach, or you see the general approach later on in our discussion. And this is because of the requirement of CBK that they must adopt the general approach in full. For insurance companies, there are varying levels of adoption due to IFRS 17 deferral to next year, and the 2019 mandatory adoption required by the regulator. Now, for non-financial institutions, most of them are using the simplified approach in determining the expected credit losses or loss provisions. Having said that, we now need to embark on the standard itself and what it requires. Now, under classification of financial instruments, IFRS 9 classifies financial assets in 3 categories. You can see my diagram there. There is 1, amortized cost. There is 2, the fair value through profit or loss. And there's number 3, fair value through other comprehensive income. Those are the only 3 categories that IFRS 9 requires us to classify financial assets. So if your financial statements are still showing that you have held to maturity, you have loans and receivables, you have available for sale categories, that means you have not complied with IFRS 9, because those are categories that were found in IAS 39. Now, in IFRS 9, you must classify your financial assets as either those at amortized cost, those at fair value through profit or loss, or those at fair value through other comprehensive income. Now, the classification of the financial instruments is based on 2 tests. One such a test is called the Contractual Cash Flows Characteristics Test. As you can see my diagram on the far left, I'm talking of contractual cash flows being solely for principal and interest. So we have the contractual cash flows characteristic test, and number 2, we have the business model test. So these are 2 tests that must be passed or must be used in determining whether we are going to classify our financial assets in the amortized cost category, in the fair value through profit or loss category, or in the fair value through other comprehensive income category. Now, for example, if we want to classify an asset in the amortized cost category, then the flow diagram on the far left will work. The first question is, are the contractual cash flows solely for principal and interest? Usually these are those things we have that have what you call basic lending features, like a loan. If the answer to that is yes, then you go to the second test, the business model test, because you have said there are 2 tests, the contractual cash flows characteristic test and the business model test. So if it passes the first test, the contractual cash flows characteristic test, we move to the business model test. And the question here is, because under the business model test, we have 2 categories. Either you are holding to collect, or you are holding to collect and sell. In other words, if you are holding, for example, government bonds, are you holding them until maturity? In that case, you are holding to collect the contractual cash flows and the principal thereon. But if you are holding them, but mid-term, you may sell them off, and there's a likelihood that you're going to sell them off mid-term. so that you can use the proceeds to make another suitable investment. In that case, then it means you are holding to collect the principal and also to sell them so that you can collect the proceeds and use them for a suitable investment. So you have hold to collect and hold to collect and sell. So then the second question there you can see is, under business model, are we holding to collect contractual cash flow only, meaning that we are holding until maturity? If the answer to that is yes, then we ask another question. Have we determined, are we used the option of fair value through profit or loss? Of course, if we have used that option, because IFRS 9 requires us, we can use that option, then we will obviously measure that at fair value through profit or loss. But if that option has not been used, because you can see that is no, then we are going to measure these at amortized cost, meaning that financial assets that we are going to measure at amortized cost are those that the contractual cash flows are solely for principal and interest, and the model or the business model is to hold to collect contractual cash flows only, not hold to collect and sell. The second one is fair value through profit or loss. And the fair value through profit or loss, you'll start again from it passing the contractual cash flows characteristic test, but not passing the hold to collect contractual cash flows characteristic test. So that if the answer to that is no, it means we are holding to collect and sell. Like you said, you're holding some government bonds or corporate bonds, but you do not intend to hold them until their 5 years term is over. You might sell them in year 3 if you find a suitable investment. And there's a likelihood that a suitable investment will be found in year 3. So in that case, you're holding to collect and sell. And then the second question is, have we used the fair value through profit or loss option? If the answer to that is no, we will measure it at fair value through other comprehensive income. If the answer to that is yes, then you are going to use the fair value through profit or loss, meaning that an asset is going to be measured at fair value through profit or loss if the contractual cash flows are solely principal and interest. And number 2, we are holding to collect and sell. That's the business model, hold to collect and sell. The third and last category of financial asset classification is fair value through other comprehensive income. And this is going to be a residual category, whereby if an asset does not fit in amortized cost category or the fair value through profit or loss category, we are going to mandatorily then now have it in fair value through other comprehensive income. So to make this understandable, I want us to look at a question here, whereby Bank A sold one of its diverse business operations and currently has some millions in cash. It has not yet found another suitable investment opportunity in which to invest those funds. So it buys short-term 6-month maturity, high-quality government bonds in order to generate interest income. Now, it is not considered likely, but if a suitable investment opportunity arises before the maturity date, the bank will sell the bonds and use the proceeds for the acquisition of a business operation. Otherwise, it will hold the bonds to their maturity date. And the question is the hold to collect business model test met, or is this hold to collect or hold to collect and sell? Now remember, as we said, and you can see I have highlighted not considered likely. We said if it's considered likely that we are going to obtain that suitable investment opportunity, then it means we are going to sell it mid-term. And that means it will be hold to collect and sell. But if we do not consider it likely, then it means that we are going to hold these until maturity. And that means then that the hold to collect business model test is met, but the hold to collect and sell business model is not met. We are holding to collect and not hold to collect and sell. So that is it about the classification. Just briefly, we have said we have 3 classification categories for financial assets. There's amortized cost, there is fair value through profit or loss, and there's the residual category, which is fair value through other comprehensive income. The classification we have said is based on 2 tests. The contractual cash flow characteristics test, that is either solely payment of principal and interest, and we have the business model test, whereby we want to determine whether it's hold to collect or hold to collect and sell. So having done the classification bit, we now want to embark on the impairment bit, because this is the area that gives us a lot of trouble and complexity. So the impairment of financial instruments under IFRS 9 requires that we use 2 approaches, either the general approach, which is mandatory for all financial institutions, and the simplified approach for retail companies or non-financial institutions. Now, if we have lease receivables, trade receivables, and contract assets that have a significant financing component, as per IFRS 15, we will have to mandatorily account for them using the general approach, or impair them using the general approach. But there's a policy election that we can use the simplified approach if regulation does not require us to use the general approach mandatorily. For trade receivables, contract assets, and lease receivables that do not have a significant financing component, we can always use the simplified approach. Now, the difference between the 2 approaches is that under the general approach, we will have 3 stages, as we'll see later on. There's stage 1, stage 2, and stage 3 loan categories. But for the simplified approach, loss allowance is always equal to lifetime expected credit losses. In other words, we are not going to have different stages of the outstanding amount in order for us to determine how much to recognize as an expected credit loss. So there are 2 approaches, the simplified approach and the general approach. Of course, there's a third approach if you are purchasing already impaired assets, which we will not discuss in this short webinar. So there are 2 impairment approaches, the general approach and the simplified approach. Now, if we look at the simplified impairment approach, in this case, the amount of credit losses recognized is based on forward-looking estimates that reflect current and a forecast of credit conditions. Obviously, most entities are currently using the simplified approach in if they are retail or they are non-financial institutions. They are currently using the simplified approach, and we shall see examples of that. Now, on the general approach, the general approach impairment model is more complex, as you can see, whereby we have loans being either in stage 1, stage 2, or stage 3. Stage 1 loans are those that are performing. There is no significant increase in credit risk. Underperforming loans are in stage 2. That means that there are some triggers or there are some events that have occurred since the loan was issued, which indicate that there is a significant increase in credit risk. For example, somebody has lost their job and the loan was pegged on salary. Some farmer has lost their livestock and the loan was pegged on the livestock. A prolonged drought has caused agricultural activities to stall. or tea prices have gone down and the loan that we issued was based on the farmer paying through their payout by the tea factories. Those are significant increases in credit risk or events that can show that there's a significant increase in credit risk. The loan moves now to stage 3, non-performing, whereby the loan is now said to be credit impaired. And according to Basel principles, a loan is said to be credit impaired if it's 90 days past due, or the obligor has applied for bankruptcy, and there are other events that can also show that the loan is credit impaired. So a loan can move from stage 1 to stage 2 to stage 3, and it can still move back from stage 3 to stage 2 and to stage 1. If a loan is in stage 1, that's a performing loan, we are only going to make a provision or expected credit loss, which we call 12-month ECL. Those are events of default that are going to take place within the next 1 year or the next 12 months. Or how much are we standing to lose in 1 year? The moment the loan moves to stage 2 and stage 3, we are now going to look at lifetime expected credit losses. Meaning, we are looking at, this is a 5-year loan. How much do we stand to lose if this obligor defaults? So don't worry about that. We are going to look at a number of examples to make it even more understandable. But before we look at the examples, I want to look at the overview of the general approach impairment model. In other words, what's the formula we are using? Under IFRS 9, the expected credit loss is equal to EAD, which is what you're calling exposure at the default. That is the balance of, for example, a loan at the end of the year. We multiply by the probability of default. That's the likelihood that the loan will be defaulted on. And we also multiply by the loss given default. Usually the loss given default is the difference between the loan balance, that is the exposure at the default, minus the present value of the collateral. In other words, we're looking at if we decided to sell off the collateral used as security for the loan, how much do we still stand to lose? Assuming we sold it at its present value. So if the loan outstanding balance is 1 million, the collateral value, present value is 700,000, then that means we stand to lose 300,000. But we'll use it as a percentage of the outstanding amount to get LGD. So ECL is going to be equal to EAD, the exposure default, times the probability of default, times the loss given default. So please make sure that you master that formula because we're going to use it in a number of examples as we discuss and wind up. So ECL is equal to EAD times PD times LGD. Now, something that is new under IFRS 9 that was not in IFRS 9 is that the expected credit loss will equal to past events plus current conditions plus a forecast of future economic conditions. We are going to incorporate past events. This loanee has defaulted before. Current conditions, there is COVID-19, which might render some of the loan portfolio members maybe bankrupt or they may lose their jobs. And what's the forecast of future economic conditions in terms of, for example, inflation, unemployment rates, or even GDP growth rates? We bring them in order to determine the expected credit loss. Let's look at an example of the simplified impairment approach, whereby company M has trade receivables of 30 million at 31st of December 2019. The customer base consists of a large number of small clients. In order to determine the expected credit losses for the portfolio, Company M uses a provision matrix. Now, the provision matrix is based on its historical observed default rates, adjusted for forward-looking estimates. Remember, we are adjusting for forward-looking estimates because of the requirement that we must incorporate a forecast of future economic conditions in our computation. At every reporting date, the historical observed default rates and the forward-looking estimates are updated. So at the end of every financial year, we need to update the observed default rates, which are the probabilities of default, with forward-looking estimates. Like, what is the GDP expected in the next 1 year? What is the inflation rate expected? What is the unemployment rate expected? And so forth. We must be able to incorporate them at the end of every financial year. Now, Company M estimates the following provision matrix at that 1st of December 2019. So this is the provision matrix, which says that the current, we have 1 to 30 days past due, we have 31 to 60 days past due, 61 to 90 days past due, and more than 90 days past due status. Now, for it, the expected default rate is 0.3% if it's current. And I remember again, under IFRS 9, we could not make a provision for any outstanding amounts that are current. But there's a requirement now that even if it's a day one loan, under IFRS 9, we must make a provision for expected credit loss based on historical default rates. So we have 0.3% for current, 1.6% for 1 to 30 days. There's 3.6% if it's 31 to 60 days, 6.6% if it's 61 to 90 days past due, and more than 90 days past due, we have 10.6%. Now, the gross carrying amount, remember we had 30 million as the outstanding, but now we have the aging list here, whereby 15 million is current, 7.5, 1 to 30 days past due. We have 4 million at 31 to 60 days, 2.5 at 61 to 90 days, and 1 million at more than 90 days past due. That totals to 30 million. Now we need to compute the provision, expected credit loss, which is going to be the default rate times the gross carrying amount. So if we take 0.3% and multiply by 15 million, it should give us 45,000. You can confirm from your end if you have a calculator with you. If you take 1 million for the 90 days past due and multiply by 10.6%, it should give you 106,000. So the default rate then the gross carrying amount, we have 580,000 as the total expected credit loss for this company is at that 1st of December 2019. Now, something you should realize is that most companies that are non-financial are still using this provision matrix. The only thing that IFRS 9 has brought in is that you need to incorporate forward-looking information. And this example, as we move on, you'll see how we are incorporating the macroeconomic information or the forward-looking information. So now, 1 year later, at the 1st of December 2020, Company M revises its forward-looking estimates, which incorporate a deterioration in general economic conditions. Now, Company M has a portfolio of trade receivables of 34 million Kenya shillings as at that 1st of December 2020, when they have now incorporated a deterioration in general economic conditions, probably maybe due to the COVID-19 pandemic. This is the aging for the company's receivables as at that 1st of December 2020. Current is 0.5, current is 16 million, 1 to 30 days past due 8 million, excuse. 31 to 60 days, we have 5 million. 61 to 90 days past due, we have 3.5 million. And more than 90 days past due, we have got 1.5 million. So that is totaling to that 4 million. Now we have increased the default rate because of the deterioration in economic conditions. Remember that it was for the current one, it was 0.3%. As at that 1st of December 2019, it's been increased now to 0.5%. If it's 1 to 30 days past the due, this was 1.6% over here, and now it's been increased to 1.8%. So generally, there is an increment. For more than 90 days past due, it was 10.6%. Now we have incorporated macroeconomic information, and we have increased it now to 11%. So that our expected credit loss, again, which is our default rate times the gross carrying amount, is 80,000 for current and 165,000 for more than 90 days past due. And the total expected credit loss that we should recognize in our books of account as at the 1st of December 2020 is 824,000. However, as at that 1st of December 2019, we had recognized 580,000. And this is just incremental. It has increased from 580 to 824. So at that 1st of December 2020, we're only going to recognize the difference between 824,000 and 580,000. So the credit loss allowance is increased by 244,000 from 580,000 to 824,000 is at that 1st of December 2020. And the journal entries will be, we debit expected credit loss with 244,000 and we credit our credit loss allowance with 244,000. So that now our expected credit loss allowance is going to increase from 580 to 824. You're not going to pass the whole journal of 824,000 because that will be not correct. Any questions you may have or clarifications you may need, you can post them on the Q&A in the chat room as we progress. So we have a second example here, which we are going to look at quickly, whereby company X has trade receivables of Kenya shillings 100 million at that 1st of December 2017. In order to determine the expected credit losses for the portfolio, the company uses a provision matrix based on a credit rating score. Now, for this one, they're using a credit rating score. Each customer is assigned a credit rating score based on their geographical location. For example, the postcode, the industry, and payment behavior. Now, something else I need to say here is that IFRS 9 requires that we cluster our portfolios based on maybe geographical location, based on the industry or the sector, or even based on the payment behavior. So we can cluster, we can have clusters so that it's possible for us to cluster, for example, loans we have issued to the agricultural sector and analyze them at that level because they have what we call similar risk characteristics. If we have issued loans to corporates, we can have a cluster for corporate loans. If you have issued loans to salaried persons, we can have the cluster for salary loans, because probably and most likely the salaried people have used their paycheck as their collateral. So they have similarity in risk characteristics, in that if they lose their jobs, they'll be difficult in paying their loans. The provision matrix is based on historical observed default rates, of course, which we have said, we are using past information, adjusted for forward-looking information. That's both current and forecast of future economic conditions. Now, the company estimates the following provision matrix at that 1st of December 2017. If the rating score for a customer is 80 to 100, the default rate is expected to be 0.5%. At that time, 49 million customers had their balance. The 49 million was the balance for customers with a rating of 80 to 100. So if you take 49 million times 0.5%, it should be 0.05%. It gives us 245,000. If it's 60 to 79, we have 20 million of them. That's the amount outstanding, and the rate is 1.5%, 3.5% for 40 to 59, 7.5 for the rate of 20 to 39, and if it's 0 to 19, they have a rate of 15%. That means they have a very low score, and the default rate is very high. So if we compute that again, we find that the default, the expected credit loss for these will be 2,420,000. But then we provide 2.4 million in our credit loss account, which includes the provision for trade receivables that are current. Remember, we said we also include those that are current. Departure from what ISTAT 9 required, that you only wait until a loss event occurs to recognize that loss. So we will now move to the general impairment approach. This one now you have to be more keen because it has more details. Now, under the general impairment approach, we recognize loss allowance, we said, depending on the stage in which the financial asset is. And we have 3 stages. Stage 1 for performing financial assets, stage 2 for financial assets with a significant increase in credit risk, and stage 3 for credit impaired financial assets. We'll look at the questions later. Tell us which ones they have asked. We have a general impairment approach. Here we have an example whereby we have got a company that if it's 1 year, the PD is 2.5%, the EAD is 1 million, and the ECL will now be 7,500. I'll show you how we are computing this, because we have assumed our LGD is 30% throughout the life of the loan. And remember that formula we discussed, ECL is equal to EAD. So for the first one, EAD is 1 million, multiplied by the LGD, which is 30%, and you multiply by the PD, which is 2.5%. This should give you 7,500. EAD is 1 million, LGD is 30%, and our PD is 2.5%. This should give you 7,500, and for the rest, if you add them, this will give us 21,720 as the lifetime expected credit losses. Our 12-month expected credit losses will be 7,500. Remember, we mentioned that there are 2 things here. We have lifetime expected credit losses. What is the loss that we expect to incur throughout the term of the loan? For example, this is a 5-year loan. In 5 years, we expect to lose 21,720. But in year 1, which is 12-month loss, we expect 7,500. If we are in year 2, our 12-month expected credit losses will be 5,760. If we are in year 3, it will be 4,320. Year 4, 2,760. And year 5, it will be 1,380. But even if we are in year 1 and the loan is in stage 3, we will have the lifetime expected credit losses, or if it is in stage 2. So we are saying if it's scenario 1, the loan is up to date and there are no indications suggesting that it's underperforming. So the loan is going to be classified in stage 1, and we provide for 12-month expected credit losses. In this case, IFRS 9 provision will be 7,500 for our first example. In scenario 2, the loan is underperforming. That means it's now going to be in stage 2. We provide lifetime expected credit losses, and the lifetime expected credit losses is going to be 21,720. Scenario 3, again, credit impaired loan. The loan is underperforming but not in default. Under IFRS 9, we are going to have it in stage 3, and we are going to make a lifetime expected credit loss of 21,720. So I want us to look at the last example, which is longer now, whereby we have Bank B applying its IFRS 9, the IFRS 9 requirement for the first time in its December 31st, 2018 financial statements, given that the standard was effective 1st of January 2018. The following information about its member loan portfolio at that 1st December 2018 is available. Loan 1 to 4, as well as all loans in group A1 and A2, share similar risk characteristics. Remember, we said we cluster them based on similarity in risk characteristics. So the bank has clustered them because they share similar risk characteristics. Group A1, group A2, and loans 1 to 4. Now, they are mortgage loans in the same geographical area, which are all secured by collateral. All of the loans were originated at the market rate of interest, and Bank B considers all loans over 90 days to be credit impaired based on historical experience with recovering the associated debt. So if the loan is more than 90 days, it's said to be credit impaired, meaning that Bank B is telling us if a loan is 90 days past due, it's going to be in stage 3. Then they're saying that the aging of Bank B's loans and the split between fixed and variable rate mortgages are as follows as of that 1st December 2018. So we have got group A1 loans are fixed rate mortgages. The total amount outstanding is 1.7 million, with the current being 1.4 million. Over 30 days is 75,000. Over 60 days is 100,000. And over 90 days is 125,000. If you add from 1.4 to 125,000, you should have 1.7 million. Group A2 loans are variable rate mortgages. The total outstanding amount for variable rate mortgages is 600,000. The current one is 500,000. 20,000 are 30 days past due. 60 days past due is 30,000, and 50,000 is 90 days past due. So the total is 2.3 million, with 1.9, 95,000, 130,000, and 175,000 as the total for the various aging days. Now, the Bank B's Treasury Department forecasts that interest rates will increase by 1% over the next 2 years. So now we are incorporating macroeconomic information. We expect that in the next 2 years, there will be an increase in interest rates by 1%. And based on historical data, Bank B estimates that a 1% increase in market interest rates usually leads to a significant increase in credit risk for 10% of the variable rate mortgages that would otherwise be in stage 1. In other words, the bank is telling us that from its historical experience, a 1% increase in interest rates will make the variable rate mortgages, 10% of them, to move from stage 1 to stage 2. Because we said a significant increase in credit risk makes us to move a loan from stage 1 to stage 2. Bank B monitors certain loans more closely on an individual basis, given their significance and unique characteristics. The following information is available without undue cost or effort on an individual loan basis. Now, some loans also are required to be monitored on an individual basis as per IFRS 9. So in this case, they are telling us loan 1 is a fixed rate loan. The amount outstanding of this loan is 100,000, and the loan is 90 days past due. And remember, the bank has told us if it's 90 days past due, it's already credit impaired. Other information available is that the borrower has filed for bankruptcy. And remember, in our discussion, we also said that if a borrower has filed for bankruptcy, that is an indication that the loan is credit impaired. The present value of expected future cash flows, including recoveries from collateral, will be 80,000. In other words, they are telling us we can only sell off the collateral and recover 80,000 of the 100,000, meaning that we stand to lose some 20,000, and the probability of default is 100%. Fixed rate number 2 is a fixed rate loan. 150,000 is the outstanding amount. It's current of now. There's no other information, and therefore we are not going to calculate any ACL. The third one is fixed rate. It's 120,000, the outstanding amount. The loan is current, but there's some other information. The borrower has breached several other covenants in the loan agreement and was recently arrested for embezzling money from his employer. This is a significant increase in credit risk because having been arrested for having embezzled money could mean that their job is at stake. And the moment they'll be fired and their loan is pegged on their paycheck, that means a significant increase in credit risk has occurred. And therefore it means the loan should move to stage 2, as we'll see later on. Now, the amount that we can recover is 120,000. So the good thing is that now, if we sell off the collateral of this loan, we'll fully recover it. So expected credit loss will be 0. The last loan, loan 4, has 50,000 as the outstanding amount. 60 is the past due status. And the other information available is that the borrower has recently lost their job due to an economic recession and was granted a concession to skip payments. That is a significant increase in credit risk because they have lost their job. The amount we can only recover is 37,000, and therefore 13,000 should be an expected credit loss. And the probability of default, we've been told, is 100%. So let's now do the computation. But before the computation, some other information available is as follows. If it's 12-month probability of default for fixed rate loans, you're going to use 2% as the probability of default. For variable interest loans, it's 1%. If it's credit impaired, the probability of default is 100%. If it's not credit impaired, you're going to use 5%. The loss given default for all the loans is 25%. Remember, we said ECL is equal to EAD times LGD times PD. So we have PD, we have LGD, and also we have EAD. We can now compute the amounts. So let's see the computation as we wind up. Loan 1, the amount we stand to lose is 20,000 because remember we had 100,000 outstanding, 80,000 can be recovered. So we stand to lose 20,000. The loan should be in stage 3. Why? Because it's credit impaired, given it's 90 days past due and the borrower has filed for bankruptcy. What's the action required? We recognize lifetime expected credit losses. And what's the ECL? It's going to be 100,000, the outstanding amount. We minus 80,000, the recoverable amount. We multiply by the probability of default, which in this case we have been told, if it's credit impaired, we use 100%. So this is going to be 20,000. The second loan is 150,000. That's loan 2. The stage it is stage 1. There's no significant increase in credit risk. We now move this loan to group A1 because it's a fixed rate loan and we do not need now to discuss it individually. We need to cluster it in each cluster. So we have included in group A1. The third loan, which was 120,000, is in stage 2 because there's a significant increase in credit risk. Let's see why we are saying so. Loan 3, we said the borrower has breached several other covenants and was arrested for embezzling money from their employer. So this loan is now going to move to stage. We recognize lifetime expected credit losses, but in this case, it's going to be 0 because we said the amount recoverable is equal to the amount outstanding. And number 4, loan 4, we have 50,000. The loan should be in stage 3 because it's credit impaired, given the past due status. Additionally, the borrower lost their job. We recognize lifetime expected credit losses as the action required. And this will be 50,000 minus 37,000, which is recoverable, times the probability of default, which is 100%. And in this case now, we have 13,000 as the amount that we should recognize as our expected credit loss for that particular loan. That's for loan 1 to 4. Now we go to the groups, group A1 and group A2. But now we'll cluster them also based on the stage. Now for group A1, we had 1.4 million, which was current, if you remember. We had 1.4 million, which was current. We add 150,000, which we have transferred from loan 2 to make it 1,550,000. These loans are current. They do not have any significant increase in credit risk events. Therefore, we recognize what? 12-month ECLs. And the 12-month ECL is going to be 1,550,000 times the LGD, which is 25% for all loans, as we said, times 2% the PD. Remember, we said the PD for all loans that are fixed rate and are not credit impaired, or for 12 months, is going to be 2%. So that's why we are having there the EAD, which is 1,550,000 times the LGD, which is 25% for all loans, times the 2% there. So that gives us that amount there. Then we also have group A1 for those that are 30 days past due. And in this case, we have 75,000 plus 100,000, which is 60 days past due, because we are having 31 to 60. And this gives us 175,000. The loans in stage 2, more than 30 days past due, presumed to have experienced a significant increase in credit risk. We recognize lifetime expected credit losses, and we compute the expected credit losses as 175,000 times 25% times 5%. Now, the 5% we are using is for those loans that have, we need lifetime expected credit losses for. Go back here and see. This is where we said that those that are not credit impaired, lifetime PD, we are going to use 5%. And then we have group A2, whereby we had 500,000 as current. But remember, we said a 1% increase in interest rate will lead to 10% of our variable mortgage loans moving from stage 1 to stage 2. So we'll have to take 10% to stage 2, which is why in stage 1, you are seeing I'm taking 500,000 times 90%. The portion not affected by 1% interest rate increase, which is 450,000. It's not credit impaired, and therefore we recognize 12-month ECLs, 450,000 times the LGD, which is 25%, times 1%. This makes 1125. For group A2, again, now the stage 2 ones, it will be 20,000, 30 days past due, plus 30,000, 60 days past due, plus the 10% we have transferred here. And this will make it 100,000. Also, we compute 100,000 times 25% times 5%, because 5% is for all those that are not credit impaired. This makes it 1250. Lastly, for group A2, stage 3, we have 50,000, which is 90 days past due. If you look at group A3 over here, group A3, we have got, group A2, we have got 50,000, 90 days past due, as you can see there. This is what we are using. So now, having done that, the remaining bit is now to add them up. We add the expected credit losses that we have computed. For loan 1, it was 20,000. For loan 2, it was 13,000. For loan 3, 7,750. Loan 4, 2,188. Then we add group A1, stage 1, that's 31,250. Loan A1, stage 2, then loan A1 stage 3, and we total them up to get 89,063. This is what we are going to recognize as our expected credit loss for this company. Let's check if that's what we computed, 2013, 7750, and so forth. You can see there, we had 50,000 as the first one for loan 1, 0 for loan 2, 13,000 for loan 3. We had 21,888